hosted by Smallcase. I am Sagar Lele, one of the Smallcase managers, and the founder of Rupeeting. Rupeeting has been operating small cases for the last 3.5 years now. So we've had a long association with the small case platform. And we're grateful that Smallcase has given us this opportunity to present our views to all the existing users as well as potential users or anybody who's just come to see who we are and what we do. So today's topic, very appropriate in terms of what's happening in the market overall. There has been a lot of volatility in the Indian markets. I'm sure everybody here, including investors and those who haven't invested, are facing the heat and coming across a lot of noise in terms of how the Indian markets have collapsed over the last few months. And as small case managers, we often get this question in terms of what do we do with this volatility? Is it a time that we get scared and stay away from the markets? Do we pull out our money? Is our money safe? Or there's another side of it which kind of is very optimistic, looking at it from a half glass full approach. And they say, is there an opportunity here in this fall? Um, as we all know, there is a very popular saying, buy low, sell high. And when the markets are falling, obviously, emotionally, there is a lot of fear. But in terms of logic, if it prevails, it can turn into an opportunity as well. But of course, whether it is a crisis or opportunity needs to be determined by putting in certain arguments in place, looking at the current situation, and then figuring out which side to take. So that's what we're here to do. We're here to tell you about what we think the markets are up to, what our view on the market is, and how we are operating in this environment. So let's begin. The overall agenda, we'll cover a few basic points over the next 20-25 minutes. We're going to keep it pretty short. We're not going to bore you with too much here. We're going to briefly tell you about what repeating is, jump on to how we're performing, and then talk about what the markets are and what our view on the market is. And then we'll follow it up with the strategy and how we're positioned in terms of the portfolio. We'll be taking questions at the end. So brace yourself and stick in and wait till the end for us to answer and address everything that you've got. So very briefly about me, I'm Sagar Lele. I've been in the markets for the last 14 to 15 odd years. Started my career in institutional broking. I was part of antique stock broking and Motilal Oswal for a very long duration. Primary role in both these companies was to do research for the institutional desk and fix up, mainly suggest mutual funds, FIIs, where to invest, and give them liquidity in terms of wherever they want to take a position as well. Moved to the buy side, managed a fund for Daiwa Asset Management for a good 2 years. That's a Japanese mutual fund. It's the second largest in Japan, and we were managing about a few $1 billion in India for them. And then I started repeating after that. We're a SEBI registered corporate investment advisory. Over the last 3.5 years, we've managed more than 200 crores of assets from over 2,000 customers. So we're pretty happy with the pickup that Rupeeting has seen over the last 3 years. New development is that we have been part of the Patterson Securities Group. This has been a fairly recent development for Rupeeting. We have a close association with this company, which is a Chennai-based broker, actually one of the oldest surviving brokers in India, started in 1892. So they have a great legacy and history. And we believe that the force of someone new like Rupeating, which has been in the market for 3.5 years, and the backing of Patterson Securities Group makes for a very formidable partnership, and there's a lot of things we can do together. But given the fact that this partnership is relatively new, we'd like to keep it a little low-key and talk about it more as things evolve between us. But for now, it's a very positive development that this name has been backing us and that we are part of this group. So we're looking at more growth and progress as we go forward. Just briefly, Smallcase was our first product. We launched our offerings into the market on the Smallcase platform. So Smallcase has been a very long time partner for us. We've got roughly 5 equity baskets on here, which are long-term oriented. We've got 3 all-weather small cases, or all season small cases. These are multi-asset portfolios which are meant for different risk profiles. And we've got one short-term product which we've recently launched. Other than that, we do a lot of personalized and custom advisory for our clients as well. These are products that are off small case. So I'll leave that there at this point in time and focus only on small case. Um, so as investors, we are fundamental in nature. We are research backed. We believe in the long term, and what we look at or aim for when it comes to investing is that we should generate supernormal returns over long durations. And by long durations, we mean rolling periods of 3 to 5 years on a regular basis. So our aim is to beat the overall benchmark by at least 5% over the long term on an annual basis, and that is net of fees and charges. So we want to do justice to people's money if we are managing it and charging a fee for it. So while there is short-term volatility in how our performance has been, I'm sure you understand that the markets themselves have been pretty brutal over the last 6 months. So we'd encourage you to look at our long-term performance and sort of take our short-term performance with a pinch of salt, whether it is positive or negative, both. Because most of our stock picking happens on that basis, and that's what we focus on. So overall, over the last 3 years, I think we're pretty happy with our performance. The best performing small case has been value migration, which has performed extremely well. And I think the rest of the other small cases have clocked a decent performance as well. And as we know, the Nifty has been pretty brutal over the last 6 months, last 1 year, in fact, from the highs, we are down by double digits. And over the last 1 year, the performance has been negative. So overall, the environment has been pretty difficult for us to operate in, but we've still been navigating pretty well. And at this juncture, when the markets have been down so much, arises the massive question of what to do at this level. When the markets have fallen so much, do we look at it as something where there is more downside still left on the markets, or do we look at this as an opportunity to actually buy in? So we'll jump right into what our market view is and not waste too much time in terms of what we do, etc. We can always come back to that. Um, so we'll start off with what has gone wrong with the market. Why is the market down over the last 1 year? And I think it is very important for us to understand this and touch upon this point in order to understand why this could reverse. So before we delve into this, I want to sort of give you the conclusion. The conclusion is that we are looking at this as an opportunity. We are looking at the current juncture as a time where the economy as well as the markets are probably turning the corner. So we would be buyers at this point in time. We are pretty positive in terms of how the markets are performing at this point and the outlook from a medium to long-term perspective. So to understand why we're saying that, I think it's important to touch upon what the current reasons for the downfall are and why we think each of those reasons are actually bottoming out or resulting in a situation which will reverse over the coming period. So we see three major problems that have resulted in the downfall over the last year. One is the overall slowdown. Second is liquidity flowing out of the Indian markets. And third is uncertainty at a global level, especially caused by Donald Trump. And we'll touch upon each of these 3 points. And then the second part of this will be why we think there is a potential reversal in all of these 3 pain points. So first, I think the most important bit is that for any given market, if you simply and theoretically break down what the price of any security of a market or a market is, it's basically going to be a function of earnings and it's going to be a function of P, right? So these two are the major factors that make up for any price, whether it is a security or an asset class. And any slowdown in earnings growth will automatically result in a derating or devaluation of that particular security or market. Now, what we've seen is that from FY20 to FY24, if you look at the Nifty 50 EPS growth, that has been at an average of about 20%. From there, we've seen a very sharp slowdown in FY25. And this slowdown is what has been the primary reason for the markets correcting. So at a very fundamental level, if you look at corporate earnings growth, they have been in high double digits throughout the last 4 years. And suddenly we are in a stage where we're actually clocking about low to mid single digits throughout FY25. So even if you look at 3Q FY25, it was a quarter which was the third consecutive quarter of a slowdown or a single digit growth. It was a very modest quarter, the last one. And the downgrade ratio in the last quarter was probably at its highest since FY21. So things have been pretty dismal at the ground level and in terms of corporate earnings. And that is a very stark difference from what was earlier. Right. So EPS downgrades have been happening, and that has been resulting in quite a lot of pressure in terms of performance for the overall market as well. Even in the fourth quarter, if you look at, which is the March quarter for which results are just about starting to get announced, the expectations are pretty low. We are not seeing much of an improvement. This quarter is also expected to be pretty modest. We're actually expecting about 5% PAT growth for the Nifty in this quarter, which is again pretty much in line with how the last 3 quarters have been in terms of moderation. So absolutely no improvement in terms of earnings growth on that front. So reason one has been that. And why have the corporate earnings actually declined, right? So we're overall seeing a slowdown in economic growth. To basically understand, I think corporate earnings growth are very or directly correlated to how the economic growth is. And for India, if you look at the GDP growth, FY25 has been moderate compared to what was previously. One of the key reasons why this has happened is that fiscal aggression itself has come off. Very simply put, the government had been spending copious amounts of money on infrastructure and capital expenditure post-COVID. And that has somewhat slowed down. So if you look at this chart right from FY20 to FY24, we've actually seen a double-digit growth in terms of capex spend every single year. And that has been very, very high, right? Like 27%, 40%, 22%, 31%. These are very high numbers for an economy overall to be spending in terms of capex growth. And suddenly, when you come to FY25, the budgeted number was 11.11 lakh crore, which was a sharp decline in terms of growth. See, in absolute terms, the amount of expenditure that the government is doing on capex has actually increased from 9.5 lakh crore to 11.1 lakh crore, right? So absolute terms, there is no decline. However, the rate at which this growth has been moderating. And that has shown up in how the economy is performing. There's a very interesting point here. A lot of you may wonder why this happens or why suddenly that dried up. We've been looking at these cycles for very long. And I mean, I've plotted out only growth since FY19, but if you go back to 15, 20 years back also, you'll see that this cycle is very highly correlated with election cycles. What you see is that in any election year, the 2 years before the election year, you'll see a massive spike in terms of infra spending. And as soon as the election is done, the next year sees a massive dry up in terms of how the government has been spending on terms of infra and capex. Now, the popular belief is that, and which corroborates well with the pattern, is that pre-election, the government does want to show a lot of progress and development in the economy, and hence there'll be a lot of ramping up of projects, speeding up of infrastructure projects, completion of work going on. And that usually results in a lot of growth. So if you look at this also, before the election year, massive spending, and as soon as the election was over, there is a dip. Similar trend in FY19, FY20 as well. And if you go back 20 years, you'll see this in every 5-year election cycle that there is a drop. We used to actually track this cycle a lot for understanding cement demand, because as soon as the government dries up on infrastructure spending, cement demand also drops massively, because about a third of cement demand in India is dependent on government projects. And now the composition obviously is much more varied. It's not just infrastructure, but also defense spending, which you must have noticed in how defense stocks have moved over the last year. It's all funding dry ups and execution lags that have resulted in this slowdown. And that itself is extrapolated into how earnings growth has been. So with that, I think the second factor that has resulted in the downfall, or the second pressure point that we've had so far, has been the liquidity. Now we all have seen the news and borne the brunt of FII outflows in the market since the last few months. This chart clearly shows how FIIs have moved out of the Indian markets aggressively. And this aggression has been sort of two ways, right? When you look at an FII, it has to be looked at from the perspective that a foreign investor has the entire world as an option to invest in. What has happened over the last year is that while India has slowed down, the US economy has remained resilient, right? India's valuations were very high and with a slowdown. So the risk reward that a foreign institutional investor would get in India would be unfavorable compared to something which he would get in a US economy, for example, which is a developed economy showing resilience and available at reasonable valuations compared to the growth. So for a foreign institutional investor, the choice becomes pretty natural at times when it comes to the risk reward. What also happened is that China had been providing a lot of stimulus into the markets and trying to rebound growth. Now, the Chinese markets, if you look at while India is expected to grow at a 6.5% in this year, China would grow at about 4.5. And while India is trading at a valuation of about 20 times 1 year forward P, China is trading at 13 times. So for 200 basis points lower growth, but valuation is at 13 times, right? So from a foreign institutional investor's perspective, they are always going to look at how much they have to pay in order to get what kind of growth. And that equation sort of stacked up pretty well for China over the last few months. And I'm talking about all of this pre-Trump, yeah. So before the tariff wars, obviously the situation changes much more dramatically once you introduce the equation of tariff wars. But pre this, this has been these two factors have been triggering a lot of the FI outflow. The other factor that has also created the FI outflow is the massive rupee depreciation. Now, very simply put, what's going to happen is that imagine a US investor is investing $100 into the Indian markets at a price of Indian rupee of 83, right? So if they're investing $100, they're basically picking up stuff worth 8,300 rupees in the Indian markets. And with the Indian markets over the last 6 months, how they've been, assume that 8,300 doesn't fall, right? It remains steady. There's no growth, there's no downfall. For simplicity, let's assume the market remains where it is and 8,300 is what they get after 6 months. Now, when they have to take the money back into the US and the rupee rate is then at 85 or 86 or 87 now in this case, what will happen is that they'll be able to take only $97 back. So they've lost out money in just converting it from dollar to rupee and then rupee to dollar. So why would a US investor invest in India, lose out money because of currency depreciation, when in fact they can just invest in local treasury yields, which are government backed, which are government bonds, which are a much safer asset from a developed economy, right? So from a foreign institutional investor's perspective, this economics just didn't make sense. And that's why you saw a lot of FII outflows from the Indian markets over the last few months. And obviously, the latest factor that has been making the news throughout in terms of volatility, adding to a lot of the uncertainty is how the tariff wars are playing out. So, of course, I don't think there's much of an update required in terms of this because it's an unknown factor which changes almost on a weekly basis. So we'll just leave it here in terms of saying that global uncertainty has peaked out and tariff wars have been causing a lot of that. Directionally, we don't know what's going to happen because every week there is a new decision and that keeps changing. So we'll say that the markets don't like uncertainty. I think the markets are comfortable knowing that the direction is down to a larger extent than they are comfortable with uncertainty. So when uncertainty peaks out, there is obviously going to be a problem in terms of how the markets perform. So coming to problems done. We've reviewed why the Indian markets have had a bad year. But why do we think that this is an opportunity and not a crisis? Why do we think that these three major factors actually are either going to reverse or going to remain stable, or can be rationalized. So we're going to quickly touch upon these to give you our logical framework of why we think this is a good time to invest in the markets and why this could be a good opportunity. At the end of it, no one's seen the future. All you can do is make a predictable outcome or a probabilistically high prediction for the future. And this can come from some logical frameworks that we put in place. So number one, I think we'll just cover what we touched upon in terms of why earnings had slowed down, right? One of the major reasons was that um, the government had been spending lesser money. So now what we want to look at is that, see, February there was a budget, and a lot of the focus on the budget was in terms of how to control the fiscal deficit and how to achieve fiscal prudence, which required the government to spend lesser money in terms of infra spend as well as capex, right? That's what we covered. However, what we're not taking into consideration, or what we think should be taken into consideration in terms of judging what the outlook will be, is that the massive tax flow that the government put out eases on in terms of personal income tax. So the easing that the government did, it's expected to bring about a liquidity inflow of about 1 lakh crores into the market. Now, why do we say 1 lakh crore? Because that's the income tax revenue foregone by the government. So effectively, that's money saved in the hands of public, which they are likely to spend on consumption. If we now combine the income tax benefits with the amount of capex spend, then it is very interesting to see that the amount of money that the government is effectively putting into the economy in an absolute term has actually exceeded that of all the past few years. Right. So on average, the government was pumping in about 1.5 lakh crore into the market to 2 lakh crore into the market through infra spend. However, if you look at this year, with the infra spend increase of about 1.7 lakh crore and an additional 1 lakh crore in the hands of public, this can result in about 2.7 lakh crore being pumped into the economy. So from a fiscal aggression standpoint, we think the government is doing a good job, and fiscal policy is expansionary enough even at this point in time. The only thing that has changed is that the composition or the recipe of this fiscal aggression has changed. Rather than the government spending money directly, it is now a mix of direct spending and spending in the hands of people. So that is something that the market has to get used to. And that is something that obviously also takes a little bit of gestation period and time for it to play out in the economy. Um, so with that, I think towards FY26, the benefits of both of these factors are likely to be seen in the economy, and likely to cause a boost in the economy again from the lows that we've seen in terms of GDP growth. If we look at the numbers, even on the GDP front, we've seen a bottoming out already, and we in the third quarter itself, we saw some amount of stabilization in terms of GDP growth, with numbers looking upwards from there. So from that perspective, we think that the economy is definitely turning a corner, and there are better times to come in terms of how the fiscal spending is. The other factor, which I want to touch upon, is that any economy in terms of stimulus or growth should be looked at from two factors. One is what is fiscal policy doing, and the second is what is monetary policy doing. Right? Uh, Over FY20 to FY24, it is important to note that the economic growth was for India was completely taken care of by fiscal policy. Monetary policy, on the other hand, was very, very regressive. And that was because inflation was a worldwide problem and a problem for India as well. FY23 was a year when most economies saw the steepest and fastest rate hikes ever. And India was also one of those which aggressively hiked rates. So, in effect, you had a very expansionary fiscal policy and a regressive monetary policy, right? However, now we're at a juncture where inflation has stabilized, and in fact, the monetary policy has reversed. So, if you look at the RBI's policy since the last few months, we've already seen two rate cuts. We have seen immense liquidity being pumped into the markets by the RBI through open market operations, through repo rate auctions, through currency swap auctions, and several other measures. So this is one of the most aggressive monetary policies we've seen in several years. And you're now at a point in time where the economy is going to be supported by both fiscal policy and monetary policy. Remember that this was not the situation throughout FY20 to FY24. FY20 to FY24 was a period of only fiscal and no monetary or negative monetary. This time it is positive fiscal and positive monetary. And both of these factors are somehow percolating into the economy at this point in time. Obviously, when the recipe of something changes or an economy is going through a flux, it's not going to be a smooth transition. And that unsmooth or rough transition is what we're seeing as an impact in the economy right now. So, from an outlook perspective, we are extremely positive by the fact that both fiscal and monetary policy are supportive, and both of them are resulting in quite some stimulus for the economy from this point onwards. Um, so that was about the economy. The other part is liquidity, right? So from a liquidity perspective, the FI outflows that we've seen, we think that that will also stabilize at this point in time. We saw parts of that happening or bits of that happening in March. However, I think going forward, this will continue as a trend where the outflows will stabilize. Now, there are two reasons for it. One of them is that India's offering better GDP growth compared to other countries. At 6.5%, despite the slowdown from where we've come, we're still at as a leader in terms of growth at a global scale. Remember at this point in time that because of US tariffs, etc., most world economies will suffer, but India will not be that impacted. India is still a very inward, still very, very low. And our direct is low, but direct impact is still low. From um, us clocking highest and at time with before, the view for an FII would be much better for India. I have to that in terms of perception of safety, US has deteriorated compared to last year, right? Because of all the tariff wars, because of high debt, because of all the uncertainty at a political level, the perception of US as in terms of stability has reduced compared to where it was. The economy is looking much more dodgy compared to where it was before. Similar for China. While valuations were cheap, valuations depend on two factors. Number one, how much growth are you offering? And number two, what is the certainty of that growth? And with China, that certainty factor definitely lacks, especially with how US is aggressively going after China in terms of tariffs. So from that perspective, I think to keep it short, the Nifty has lost quite a bit. Valuations have come down to a 5% discount to the long period average for Nifty. And the economy is turning around. So from that perspective, India offers a better opportunity compared to what it did in FY24. And with a stable rupee now, we think that FI outflows will actually stabilize and probably even result in an inflow going forward. And the last factor we want to touch upon is the uncertainty. And the one thing we've learned in terms of how to deal with uncertainty is that you simplify things, right? So in terms of tariff wars, there are a couple of views we want to give out. One view is that, see, Trump has been extremely erratic. He's known for making promises, passing certain decisions, and withdrawing them immediately after as well. So from that perspective, how seriously or how end of the worldish you should make sense of any of his decisions, we are highly sort of skeptical of taking it too seriously till it's actually implemented and real, right? The second most important factor is thinking about it from a very logical standpoint. At the end of the day, any tariff implementation on any country, especially to the extent that we've seen of 50% plus, is going to be inflationary for the US. The US depends on a lot of imports because production and manufacturing outside the US is cheap. it is not possible for the US to overnight turn into locally manufacturing all these objects that they currently import. So import substitution is not a realistic short-term solution for the US. So at the end of it, if you have to think about why the US is doing this, it is probably just to get a better deal out of countries, right? So when it announces an array of tariffs, it is probably just to get other countries down onto the negotiating table and strike a better deal. And even if any deal is struck, it is still a better situation for the US compared to earlier. And you can see that from how the tariff war is played out, right? Most of these tariffs being taken back indicate that this was a situation of more of arm twisting other countries into making a deal rather than actually implementing it. And a good reality check was given to the US through the bond markets. So bonds are usually looked at as a safe haven. And whenever there is a turmoil in the equity markets, people do flood to safety havens or relatively safer assets like US bonds, which are the benchmark of safety. However, what happened during this time of tariff wars was that yields in the US bonds were shooting up, which indicated that people are not really liking what's happening. They're considering this as a highly risky place, and they were actually flooding out of the US bond markets. What this resulted in is that at the end of it, if the yields go higher, the amount of debt that US has to repay comes in at a higher rate. And US is anyway facing a pressure in terms of its debt repayments. And if it has to start repaying its debt at a higher rate or issue new bonds at a higher rate, it is troublesome for the economy. So it was best that they rolled down on their intent when it came to tariffs, and that's what we've seen. So, from that perspective, we think that the worst is behind. India being a relatively inward economy, low exposure to US, and considering how the entire tariff war is going, we think that there is more noise here than one needs to pay attention to. So let's just keep it simple and focus on domestic factors and be more selective in terms of the stocks you pick up. So we'll come to our strategy, but before that, there are some questions on the live which I'd like to take up before we jump into how we're dealing with or how we're looking at positioning ourselves in terms of strategy for the coming months and quarters. So one question from the YouTube chat is, how does this correction compare to past ones in terms of magnitude and triggers? So this correction has been pretty prolonged, right? I think anyone new entering the markets after COVID has not seen such a prolonged duration of correction. Usually, we've been in an upward trend, and an upward trend is obviously not going to be very linear in nature. It goes through minor bumps on its way. But this time, for a good 8 to 9 months, we've seen a consistent downfall in the markets. So this correction compared to at least the last 4 years is a little bit different in terms of magnitude as well as duration. It is slightly elongated, and that's what's scaring a lot of people, to be honest. However, what we need to understand is that structurally, are we heading to a better place as a country, as an economy, and hence as a market? So we keep trying to tell our investors this, that from a 5-year perspective, do you think India 5 years down the line will be in a better place compared to where it is right now from an economic standpoint and from a corporate standpoint and hence from a market standpoint? Just by looking around you and looking at the development that is happening around you, do you think we'll be in a better place? And if the answer is yes, then structurally you're on the right path. Right. So in the interim, whenever there is a fall or whenever there is a downfall that is troubling the markets, as long as your long-term vision is set and you're fairly confident about that, you should utilize these as opportunities to buy into the markets. So we'd say this correction somewhat, the prolonged duration of this correction gives you that opportunity for a longer duration in terms of picking up stuff. Um, Another question is, are valuations in certain pockets looking historically attractive? For sure. I think at a broader market level, if you look at the valuations at 20 times 1 year forward P, the Nifty is just 5% below its long-term average. So it's not materially at a discount. So it's not something where you'd say that, hey, it's at such a large discount that you want to pick it up. Just to give you some perspective, I think this chart earlier, yeah, this chart gives you a good perspective in terms of how valuations work out. If you look at the COVID fall, valuations had fallen much below long-term averages, and this was an obvious buy at that, obviously in hindsight. However, if you look at the current valuations, it is just slightly below the long period average. So we're not there yet. However, I think how we're looking at the markets is slightly different. If you look at the last 4 years, anything that any investor touched would usually turn into a good return, a positive return. However, we think that that is not going to be the case in the future. I think it's going to be a stock pickers market. We are not going to see a very uniform bull market going forward. There are going to be certain pockets or certain parts of the market which will do extremely well. So we need to be much more selective in terms of how we're choosing our stocks. So yes, there are definitely a lot of pockets in the market which are looking extremely good in terms of valuations. And that is not obviously reflected in the broader index. But if you look deep down, you'll find a lot of sectors and a lot of stocks which have been historically very expensive come to decent valuations. In fact, one of the strategies that we apply in several of our products, including the PMS, is we make a bucket list of stocks which are never available at decent valuations. Look at, for example, Dixon Technologies. Look at someone like a Linde India. These stocks are always expensive no matter what the market situation is. And whenever there are sharp falls in the market and these stocks come to comfortable levels or levels that are attractive in terms of valuations, we keep adding these stocks to our watch list and probably even act on some of them in terms of buying them because otherwise they're never available at better valuations. Um, Another question from the YouTube live, which sector is most likely to rally next? This is a little bit of a hard one because rally over what duration is what we need to understand, right? Are we talking about from a short-term perspective? Are we talking about it from a long-term perspective? And the answer materially changes. But overall, we think that looking at how the overall economic situation is and what the fiscal and monetary policy are doing, we think that consumer is a good space to park yourself in when it comes to relative safety as well as the triggers the sector has to offer in terms of growth going forward. So overall, I think consumer healthcare, these sectors appear to be fulfilling both criteria. Number one, relative safety, and number two, triggers for the future as well. The other probably theme that one could look at is, as we mentioned, in terms of election cycles, right? While election funding or elections infra-related spending or government spending towards capex usually dries down right after the election, right? So if the election, say, was in 2024, 25, 26 would see moderation in terms of infra spend. However, that would start picking up 27 onwards. So from that perspective, if the valuation for a lot of these capex related spend ideas have corrected because of a dry up in spending, these could be picked up from a 3-year time horizon because again, before the next election cycle, you'll see a ramp up in spending for infra as well as capex. So those are a few sectors from different timelines for you. Is this a good time to do an SIP or invest? I think I paused at the right time at this place because we are positive on the markets. We are very selective in terms of where we are putting our money. And the last thing, we're taking a very staggered approach. So while we've been sitting on maybe 30-40% cash over the last few months, we have been deploying a lot of that cash periodically and not in one shot. So right now we must be at about 10-15% cash levels in different products, and we will actively look to deploy that as well. So to answer that question pretty simply, a staggered manner or an SIP is usually better because the downfall has been prolonged. And there is no point sometimes trying to look for the bottom or trying to catch the most bottom point. That is a very futile activity in the present. It usually makes a lot of sense in the hindsight and in retrospect. Unfortunately, we don't have that benefit at this point in time. So we would always recommend to especially during tough times, to continue SIPs, to not stop SIPs, to continue investing in the markets, because that is the only time you'll get as an opportunity to lower your overall cost of buying. So these are times when you need to pump in more money and not really exit out of the markets. So yes, good time to invest SIPs during this fall. Another question before we move on. What do you think about the PSU and defense sectors? See, PSU and defense, as we mentioned, the fiscal policy moderation has resulted in a downfall of these stocks because suddenly new orders have dried out. If you look at the defense sector, the amount of orders that these companies were getting over the last few years versus the amount of orders they have gotten in the last year, there is a massive slowdown there. If you look at the execution speed, that has also reduced, and hence you're seeing defense stocks come under pressure. But we think there will be a revival in that. There are enough signs from the government and in terms of how the cabinet is approaching this, in terms of the order pipeline, in terms of the measures they're taking, even in order to reduce the time of rewarding orders. All these things are indicating towards some amount of a pickup that will come in terms of defense spending over the next few months. So if valuations are attractive and the sector hasn't done well so far, this downfall and the higher gravity downfall in the sector could actually turn out to be quite an opportunity to accumulate these stocks from a longer term perspective. So we'll pause on the questions for a while, and we'll get back to the last part of the presentation, which is if there is an opportunity, how do you play the opportunity, right? And the recipe for growth is different, and hence our strategy for playing this opportunity would also be very different this time around. So we are overall positive on the markets. However, we are extremely selective in terms of what we're picking up. We have a very high preference towards market leaders, towards companies with very good corporate governance. We have a preference towards companies that have higher value added products rather than commoditized products. We like companies that are backward integrated, and hence that have a significant buffer in terms of margin pressures, or the ability to cushion margin pressures. And at the same time, we like stocks that are relatively cheap. So I think we've got a long list of criteria when it comes to selecting stocks. So clearly, we are very cautiously optimistic about the future, and hence that is being reflected in the extra vigilance and prudence that we are putting in terms of stock selection. Why this? I will give you a very brief example to explain this strategy. You look at the tariff wars, right? Last week or the week before that, if you look at how the tariffs were implemented, everybody was scared of investing in any chemical company that had a significant exposure to US exports. However, what happened after that was that the 90-day pause changed things dramatically in a minute. Suddenly, what happened is that India has a significant advantage over China in terms of exporting to the US. However, what China will start doing is, because it's anyway producing, it is pumping in a lot of stimulus into the government, into the economy. What will happen to all the stuff that China is producing? Instead of it going to the US, that stuff has to go somewhere, right? So they'll start trying to pump it into other economies. Now, what happens in chemicals is that base you can pump into any other country. Not that big a problem in terms of getting approvals, getting regulatory stuff done. However, in terms of putting advanced chemicals out there, which are especially critical in food or in pharma applications, the regulatory process is pretty long. So it takes about 3 to 5 years to set up an ecosystem to actually start supplying to another country these critical chemicals. Now, how does this change things? Interestingly, what will happen is that there will be a lot of pricing pressure for base chemicals because China will start dumping their chemicals into other markets. However, for advanced chemicals, pricing will remain sticky and probably India will have an advantage because China can't really supply to US at the same prices anymore. So, from a blanket negative on chemical companies 2 weeks back, last week, the equation turned in favor of companies which are producing advanced chemicals and not base chemicals. Now, how does our strategy tie into this, right? Overall, we don't know what the future will be. So, better thing to do in this uncertainty is to park yourself in fundamentally strong companies which offer a lot of cushioning. So if our preference is for a chemical company which has higher value added products, they are going to be safe from the pressure in terms of base chemical price erosion, right? At the same time, if we are focusing on companies that are backward integrated, they are producing most of their raw materials and hence raw material availability and dumping from China is also not going to be a problem. So margins are also going to be relatively protected. And at the same time, because of the recent corrections, if any of these stocks have been available at a decent discount or a valuation gap, it's a great time to pick up. So from that perspective, I think although there is uncertainty in terms of what is going to happen, if you're going to make it a prudent approach when it comes to your investment framework and methodology, I think you can sail through a lot of that uncertainty without too much of a wavy performance. So from that aspect, we are being extremely selective, and I think that is working beautifully for us. Obviously, there are going to be near-term volatility pressures, but from a long-term perspective, I think that approach is working pretty well. And in terms of this is how our portfolios are currently positioned. This is more or less an aggregate of how our strategies are. We are more biased towards large caps at this point in time. Mid and small are about 50, large caps is about 50. That's because we are seeing larger value in large caps. Valuations are comparatively decent in large caps relative to mid and small caps. At the same time, what's happening is that mid and small caps, there are several pockets emerging. So what we're doing is we're slowly, gradually picking up some mid and small caps whenever there is an opportunity. This is a very interesting chart, usually in terms of how our portfolio positioning has moved over time. If you look at the entire downfall that has happened over the last year, we had significantly increased our large cap exposure there. So large caps are usually a good cushioning place. Whenever the markets fall, large caps, if they fall by a certain value, mid and small caps will usually fall by a little more. So from that angle, we've been creating a lot of safety pockets in our portfolio and hence containing our downfall in this scenario. So going forward, I think our bias will remain towards large caps for a little bit more in order to keep continuing that safety net. However, we'll be picking up mid and small caps whenever opportunities arise, and that you've seen in the last month. For example, we've reduced our large cap exposure slightly and picked up some small caps which are available at decent valuations. Similar with defensives, we had parked a lot of money into defensives before because the markets were so volatile. But now since we're staggering it out and deploying the money, we're getting a lot of the non-defensive stocks at better valuations. So we're slightly reducing the exposure towards defensives as well. So with that, I think we'll stop here in terms of what we had to present. That was our view on the markets, which is positive, and that's what and a brief on the strategy we've been implementing. We'd be very happy to take questions if there are any that we can address at this point in time. Alternatively, what we can also do is that you guys can post your questions and answers, questions and suggestions to this email ID. It's saval@rupeeting.com. Whether it is questions about the markets, about this presentation, about our view, about our performance, we are very happy to answer any of these. We're always available on this. You can alternatively WhatsApp us on this number as well. Available constantly to address any questions there as well. One question has come in. What's your biggest worry right now? Valuation, global cues, or politics? See, from this year's perspective, I think politics is not really that big a problem. There is not much of political agenda set for this year, not much political action expected. So relatively stable on those terms. We don't expect much. However, I think from a fiscal point of view, obviously we are expecting much more action this year. Because we've come out of the entire election fiasco, and the government will start focusing more in terms of budgeting, spending, bringing back the economy, etc. So from that angle, I think rather than it being a worry, I think it's one of those factors which we are looking forward to in terms of focus coming back from a political standpoint. Global cues, yes, they are. I think global cues would be the largest worry at this point in time, because at the end of the day, even if India, we say that it's an inward economy, our export exposure to US is only about 2%, so we are safe from all that. We get a distinct advantage over China when it comes to tariffs. We can say all of that, but at the end of the day, if the economy of the US itself goes down, or if that looks a little uncertain, or if that looks a little dodgy, then the entire world is going to be affected. And at the same time, India is not going to be not affected or cushioned from that, right? So from that perspective, I think domestically we're doing great, but the biggest worry right now would be global cues. So even when our portfolio positioning, as far as our portfolio positioning is concerned, we are looking at two things. We are looking at heavy domestic plays, and we are looking at parking ourselves away from any export dependency, unless obviously it fulfills our selection criteria. So that would be the largest worry. Valuations, not so much again, because I think valuations are very highly correlated with how growth is. So if you look at high valuations also stick around to high levels as long as growth is coming in, high growth and certain growth. As long as these two factors are coming in, high valuations are not a problem. And if we look at the Indian economy, if the economy we think is bottoming out and growth will start going upward from here, then valuations again should not be a problem. Especially now that we've come to long-term averages, or a slight discount to that compared to the steep premium that we were trading at earlier. Um, Another question, tariff war might keep going on for a few more months. Do you like to reduce exposure to exporting companies and more on domestic? Yes, we've been doing that already. So we've already been parking ourselves more towards domestic companies and less towards exports. Even in the IT sector, we had a significant exposure a few months ago, because there were domestic problems, and we found that as a relatively defensive spot to park ourselves in. But over the last couple of months, we've cut that down as well. So when it comes to exports, I think we are again very selective. Only value-added products, only backward integrated, and relatively low exposure to the US. Uh, but however, I think it's a good spot to keep an eye on, because when the turmoil is maximum, is when the stocks will take a maximum hit as well. And that's when they'll give you good opportunities for the long term as well. So while we are avoiding them right now, I think the entire team is very actively tracking these names, and trying to see if there is some opportunity that comes our way in order for an investment from here. Um, yeah. Next question is, what's your plan of action for value migration small case going ahead? So value migration small case, we get a lot of questions on this, especially because that's our best selling small case. That's the best performing when it comes to the last 3 years. And in all honesty, if you look at the performance for the last 6 months, we've sort of underperformed compared to Nifty 500. We've lost out about 18.5% compared to 11% on the Nifty 500. So, of course, we are aware that that is a problem area. However, we've made some changes to that in the last rebalance as well. And that is already starting to reflect in terms of how our performance over the last month has been. So if you look at the last 1 month, we've made up for some of that underperformance in the last month. So from the overall value migration standpoint, I think there are very simple things that we're doing. We're adding a lot of financial exposure. We're adding private banks, we're adding NBFCs. We are still large cap heavy on that. So we're still in that capital protection mode when it comes to value migration. But that is slowly changing gears. We are slowly starting to get more aggressive and retain what the value migration proposition was, which is mid and small cap heavy, play short term themes, not short term, but themes which play out over 6 months to 1 year or 2 years. Pick up stocks that give you material outperformance with short durations. That obviously was very difficult to achieve in a downward market. I think because the theme itself is such that we are playing a certain migration from one end to another. This small case works best when it comes to sideways markets and up markets. However, now that we see things stabilizing, I think we are pretty content with how the portfolio is positioned, and we're pretty confident that this will come back to its lost glory. Um, so no worries there. I think we're set in terms of our strategy as well as positioning for value migration. Okay, so I think if we're done with questions for now, we'll wrap the session up. As always, very happy to stay connected with all our users as well as potential users on a regular basis. Just to reiterate, we are always available. You've got our email ID and phone number here. So if there's anything we can help on or address, we're available on both of these. Now, because we've done this with small case and this is a special webinar there, we're offering a special discount code as well on this. You'll find the details in the caption below. So you can go ahead and avail that discount at any point on our 1 year plans. So with that, I think we'll wrap up. We'd like to thank the entire small case team for this opportunity. We hope to do many more sessions like this going forward. All your questions and comments as well as suggestions and feedback are most welcome. Thank you all for being with us, and see you again soon. Thank you.